Welcome to Local Leverage, your competitive edge in business. As always, today's show is brought to you by PropertyRadar, the hyperlocal lead generation platform for small local businesses. Today's guest built his first brokerage at 21, sold the tech arm for 7 figures before he was 25, and is now a top 1% loan officer in the United States and a seasoned expert in lead generation for independent mortgage brokers. He's the founder of Grow Mortgage, now Willow Home Loans, and currently leads innovation as the Chief Technology Officer at Milestone Mortgage Solutions. Today we're breaking down how to define your area of specialization, identifying your target audience, and establishing a lead generation engine that is sustainable and effective. Without further delay, please welcome Russell Petty. Welcome to the show. It's great to have you.
Appreciate it. Thanks for having me on.
Yeah, man. You are an expert in many of the things that our audience is eager to learn about. I mean, they want to be running successful campaigns for lead generation, and you've got a ton of experience here. And so my ask for you in this conversation is let's give some of that sauce, you have, and I really want our folks to walk away from this conversation with some actionable learning that they can go implement right away and do better lead generation. Maybe just from the top of it, I'm curious. I know you're a big proponent of cold outreach in the mortgage space, and that is very much in alignment with my philosophy. Tell me a bit more about that. Why do you think that is such an effective lead generation channel or activity set for mortgage professionals in particular?
Yeah, so I mean, you've got 8 ways to get business realistically. 4 of them, called the core 4, is what Alex Hormozy calls them. You got cold outreach, warm outreach, affiliate, and referral. I think cold outreach for the majority of the industry is the most impactful, but it depends on who you are. You can do incredibly well with any of the 4 or all of the 4, really. I would just suggest you pick which one you want to do the most or which one you're most comfortable with, and you go all in on that one. You don't really need to do all 4 of them. I picked cold outreach because for me, I found with social media, it was the easiest way to get to as many people as humanly possible without going and doing one-on-ones. I was never a big fan of just going out and sitting there cold calling all day long trying to set these meetings, whereas if I can make a post and have them come to me, I thought that was a lot easier. So I think cold outreach, when you're doing it the right way, when you're not going in with an ask or an expectation, is the most powerful for me personally. But if you're somebody that doesn't really like doing cold outreach at all, you could do incredibly well with any of the others as well. It's just cold outreach is the one that I chose.
Yeah, I agree with that. I think, my philosophy or my outlook on it is that within cold outreach, I prefer targeted outbound as the primary. But I think we're talking the same thing ultimately. It's really instead of just relying on your referral base or on prior clients, go out and shake the trees and find people that meet your profile or that that you can service really well. Why do you think that most LOs shy away from cold outreach or from targeted outbound?
I think a lot of times people say it's because LOs are lazy or this or that. I don't think it's that they're lazy necessarily. I think the majority of them have no idea why they would reach out, right? So if you're a loan officer listening to this and I told you that today only you had 0% down, 0% interest, no credit check, no income, no assets required. If the person wants the house, they get the house at no interest with no money out of pocket, and after 12 months, the whole loan's forgiven. You would go and call every person you possibly could. You'd call every realtor, you'd call every buyer, you'd go knock doors on cars at Walmart parking lots. You would tell everybody. The problem is not that they are uncomfortable with cold outreach. The problem is not that they don't know social. The problem is their offer. Until you know why you will never be consistent. You'll never want to reach out. If they just focus on the offer, they will do the outreach. But no one wants to call and tell someone else about something that they don't believe in. It is because they don't believe in the offer. They don't know why on earth this person would work with them. And in their heart of hearts, they know that their offer is shit, so they don't do the outreach. If they believed in the offer, they'd believe in the outreach and they would do it more consistently.
Yeah, I love that. I think that know you is such a critical piece. Many of the LOs that I talk with struggle with that. When I ask them, what's your specialty or what is it what's your niche? They can't really distill that down. Instead, they default back to, oh, well, I do FHA loans, and I can do, this type or that type. Like, no, those are the products you sell. That's not about you. I think this is a really critical piece that you're hitting on. How do you suggest an LO find that unique position for themselves?
The first step is to start looking, right? Because I think a lot of them feel that they have it. And when you ask them, who's your avatar? Well, first-time home buyers. Okay, well, that could be an 18-year-old guy,
Right.
could be a 65-year-old woman, like two very different things. You need to hone this in more, right? So I think the first step is to realize that you don't have it dialed in yet. The second step is I actually have a formula for it. So you take your archetype, which is what they probably think that their avatar actually is.
Right,
And that's
right.
first-time home buyer, your veterans, your, whatever it may be, your FHA buyers, your people that live in Quail Hollow, whatever that is your archetype. And then you want to go and you want to do discovery. And you need to talk to at least 500, not reach out to, talk to 500 of those. Have a conversation, have a coffee, break bread with these people. You need to define what their goals in life are, what is keeping them from reaching those goals. Because they haven't thought about that, I'll tell you that. Most people know they have goals and they have no idea what's going to keep them from getting there. They sometimes know what their plan is to get them, but they've never thought about, well, what are the things that could keep me from getting them? Find
Right.
those, solve those. Find their goals, find their personal goals, find what they enjoy, find where they want to be in 5 years. Then you need to go and you need to find people that are where they want to be, and you need to figure out how they got there. So not only are you talking to that specific avatar, you're figuring out where they want to go, and then you're talking to people that are where they've wanted to go and figuring out how they got there. And then you're mending the two together, because now you can see the future. You're speaking to that avatar. Gary Vee's got a great thing about this that I'll probably butcher here, but if I'm selling cashmere jackets or cashmere sweaters, right? If I want to sell those and I just go out and say these are cashmere sweaters, they're the best sweaters in the world. Okay, like maybe some people
Right.
will buy them if I get it out enough, but what if I go out and I have, Ronaldo wear the sweater? Go, these are the ones he wears when he plays soccer. Now I'm going to get all of the people in this age group that enjoy soccer, that enjoy Ronaldo, because I've attached it to something, right? So by doing that, though, I'm going to get a lot of people that hate Ronaldo that will never buy that sweater.
Yep.
And that, I think, is where a lot of people get afraid to define an avatar.
Right.
When they go into that avatar and they go into that niche, they are going to lose other business because now they are associating with something. And they don't know why them, so they're afraid to lose any business. And that's why they say yes to everything. That's why they do not turn clients down. It's in the client's best interest to be turned
Right.
down and put a plan in place. So you have to do that association, but in order to do the association, you have to understand the avatar, and that's just from discovery. Talk to as many of them as you possibly can. Figure out what they want in life, what's going to keep them from there. Talk to the people that are where they want to be. Preferably, you are that person already, so you don't have to talk to that person, because then instead of saying, well, this is how you, and it's something you've never done, it's here's how I did these things. Here's how I bought a car at 25. Here's how I purchased my first investment property at 27. Now you can go in and do those things. So who can you possibly help the most, and then pour into those people with no expectation.
Yeah, and you're talking my language on this. I love this idea of niching down and truly understanding your ideal customer, right? Not in the broad sense, but very specifically, who is it you serve, and who are you uniquely positioned to serve better than anybody else? And so that brings me then to how you use that information now to create highly converting, resonant messaging. Like, how do you approach it? I think I understand based upon just the niching that you're talking about, but I'd love to understand how you would approach the creation of winning messages.
Yeah, so I use what, again, Hormozy. I mean, 99% of what I do is from Alex Hormozy. The man's a genius. So he has a value equation. So you take their dream outcome, right? So you know now who it is, and you know what they want. You know where they want to be. What is their dream outcome? And a lot of you listening to this right now are thinking they want to buy a home. No, they don't. The average person buys a home every 5 years. That is not the solution. Help them with their personal life, because what's going to happen is when you help someone achieve a goal in their actual life that has nothing to do with you, you are building goodwill. If you are marketing as a loan officer loans, there is a direct ask right there, which is buy a house with me, right? But if you take somebody that maybe it's veterans, maybe that's your archetype. It's veterans that just finished their second deployment and they're married, right? And they're about to re-enlist for a third. what is a problem that person has? Well, they miss their family, right? How can you make it where they can be as close to their family while they're gone as possible? Well, that's dream outcome, right? They want to be with their family. How can we have that happen, right? That's an example of what I'm talking about here. But depending on the archetype, you take that dream outcome, and then you look at the perceived likelihood of achievement. How can I make it so likely that their dream outcome will be achieved that they go, it will happen? Because people don't buy when they don't believe that the thing will happen. If I told you that, you could make $5 million this year, absolutely no matter what. No matter what, you can make $5 million. That's your dream outcome. It's going to happen. I promise you, here's the check, and it unlocks. It's in a locked case, and you get it after 1 year. You believe that the perceived likelihood of achievement is 100%. I'm going to get that check, right? But if I just tell you, hey, come join this commission-only job and you'll make $5 million, I don't know about it, right? But if you tell someone there's $5 million at the end of the year, you get it no matter what, and you put it in a box that unlocks and hand it to them, but they have to quit their job, they will walk out of that job, unless they're making $6 million, I guess. But the way you can do that as a loan officer is reviews. You need to not only ask every client for a review, you need to ask for it multiple times in the process. Not only do you need to ask the client, you need to ask the listing agent. You need to ask the buyer's agent. You need to ask the title company. You need to ask the insurance agent. Anybody that is in that, the transaction coordinator. Every loan is not just a chance at one review. Every loan should be a guarantee of one, hopefully a guarantee of 6 or 7 reviews. Because now, when I go out and I'm reading reviews, nobody reads second page of reviews. People barely read the first 5 reviews. They'll read one, they'll go, here's the rating, good to go. So if you have, though, listing agents that have left you reviews, and you have a client that's putting an offer in on a home, you can increase the perceived likelihood of achievement that you will close by showing them the 75 other listing agents that have said, this guy closed on time. If you have a buyer agent you want to meet with, and you have 100 buyer agent reviews that say that you do a great job, you can get that buyer agent to meet with you. If you have a client that goes, why would I work with you? Well, here's 1,000 reviews that I have that say that I do a really, really great job. Read through those. Perceived likelihood of achievement is pretty damn high at that point, right?
Absolutely.
So once you have that, then you look at the time delay. Now, if I told you, no matter what you believe now, you're going to close on the home. My closing timeline is 9 years. You no longer want to work with me. It doesn't matter. So you go into time delay, right? So you look at the time delay. How can I make it where this happens as fast as possible? Matt Ishbia says this all the time. Time kills deals, right? So you need to go in and have it fast. That's why UWM's number 1. They are fast. You have to go in and get that time delay down. How can you make your application process faster? How can you make your pre-approval process faster? How can you make your underwriting faster? How can you make all of these things go quicker? Because if I can close you in a week and someone else closes you in 3 months, you will pay more for the time to get it now, right? So perceived likelihood of achievement, time delay, and the last thing is effort and sacrifice. If you know for beyond a shadow of a doubt that you're going to close on the home, and you're going to close in exactly 7 days, but unfortunately, you have to not eat or drink, and you can't see your family for those 7 days. You may not want to buy this house anymore, or at least it's going to be deteriorated, right? You got to walk through this glass field to get it. You don't want it anymore, so effort and sacrifice. How can you make it as easy as humanly possible for them to accomplish the dream outcome? So they know they're going to get it. It's going to take as little time as legally possible, and the effort and sacrifice for them is next to nothing. Now you have an offer, and now you can start doing outreach. And I'm going to tell you this, all officers listening, when you start doing outreach and you think this offer is bananas, it's the best offer ever, it's probably going to suck, because now you realize what this job actually is. And it's coming up with 100 offers and hoping that one of them is actually good. And then going back in, plugging it into this formula, figuring out where the offer broke, and then bringing it back out again. You have to continuously do this, because now you have something to call about. Now, hey, do you want this? Well, what do you mean you don't want it? I thought you'd love it. Which one of these 3 would you say it is? It's effort and sacrifice? Well, damn it. All right, let me go back in and fix that one. And then you know exactly what to fix on your offer. But that long answer is how I define what do I actually help the avatar.
Yeah, no, I love the framework. And when you talk about kind of that dream outcome, is that synonymous, or can that be synonymous with, understanding the pains as well? Because it's often, people are motivated by that dream outcome. They're also motivated by the fact that I've got an issue, I've got a pain that I have to solve now. Do you differentiate those? Do you see those as and maybe to that question, I guess, why dream outcome and why not pain?
Same thing. In my mind, they're the
Okay.
same thing.
Okay.
Your dream outcome is to stop being in pain.
To stop being okay.
You want
Excellent.
to find people that are in pain, and that is who you sell to, right?
So to your point, I mean, you got to both know what is that future desired state, but you also have to understand what are the emotions and things that are within that pain. It's not just the fact that maybe I'm going through a divorce or whatever. It's what does that really mean? What it means my children may be uprooted from a school, or there's other things at play, right?
Yep,
Yeah, talk a little bit about that.
Yeah, so the more pain someone is in, the more of a price they will pay. If I'm selling you a glass
Motivation.
of water for $100 and you're in a restaurant, you will probably not buy the water, right? But if you're in the middle of the Sahara Desert, you'll empty your 401k for that glass of water. The more pain they are in, the higher a price they are willing to pay. And I'm not just talking about money. I'm talking about, let's say that, you have a non-QM loan. Getting the pain and effort and sacrifice down and the time delay down and the perceived likelihood of achievement up is a lot more difficult by default with that. It's going to be harder. But the reason that people go through that route is they cannot buy the house otherwise. They have no other option. It is only non-QM. So if you're doing non-QM and you can't do the 7-day close, it is offset a great deal because their pain is a lot higher. So you do not have to have UWM speed. Now the good thing is they do non-QM, so you could send it there, but you don't have to have a 7-day close when they're in that much more pain. You know what I mean? And what I don't want people to do is take that, because this is usually the way that they take this. I should do bad credit loans. I should do down payment assistance and the reason that people gravitate towards those loans is because the people will put up with more. It's not that they want to do those loans. Nobody wants to do 1,000 DPA loans a month. It is because they don't know why they don't have a better offer, so their value is so much lower, they have to go to the people that are in more pain in order to sell. So once you have the better offer, you can sell to a better consumer. Now, I'm not saying that those people should not buy homes, but the majority of those people probably should not buy homes. I've seen so many loans where the consumer gets this horrible process, terrible process, and they put up with it because they have no other option. They get put into a home with down payment assistance where they have 102% or 101.75% LTV day one. They already didn't have money for down payment. Now they're upside down because they have a first mortgage, a second mortgage, upfront MIPs rolled in. They've got all this stuff. Now their hot water heater bursts and they can't afford to fix it. And now the home goes down to get a foreclosure. Whereas if you had just taken 6 to 8 months and put that person on a plan and worked with them, could have had a way better loan, right? I'm not saying no one should do down payment assistance, but I'm saying that a lot of loan officers, because they don't know why they work with these people in way more pain because they'll put up with it, and they put them in loans they shouldn't be in the first place. You're never going to get a good review that way. So finding people that are in pain is not to take advantage of them. It's knowing how to structure your offer around it.
Yeah, I mean, and if you, to your point, if you specialize in that, if that's your niche, then you're providing help and service to those people. You just happen to be identifying them because of the pain point.
Right.
So let's talk about that a little bit. I know you're a big proponent of using data, using it deeply for the creation of an audience. You've gone through this effort now. You've identified kind of this this profile or avatar of a very distinct niche. How do you go about finding these people, and then how do you tailor messages to that group?
Yeah, absolutely. So I'll use my niche as an example. So I deal with luxury that isn't quite luxury, are usually buyers.
Okay.
And I joke with them about this. So my clients are usually, one of them referred to themselves as this like a year and a half ago, and I've stuck with it. They're McMillionaires, is what he called himself. And
Yep.
I love it because it fits so well. So these folks are people that, maybe they've got a 50% debt to income ratio, but they make $500,000 a year, right?
Yep.
And these folks, they're living at their means, we'll say. They've gotten a promotion, they've gotten a nicer car. They've gotten another promotion, they've gotten a nicer house. There's never anything in between. The positive things for these folks, the negative for them, the pain point is they're capped. They make great money, but they are spending all of it, right? Usually who I speak with. So those folks are software developers, a vice president, director, senior vice president. I don't do a lot with executive vice president because usually those folks aren't, A, can't outspend their wealth, and B, they have a financial planner that has it in some sort of a thing that is losing money that I can't compete with. So usually it's those folks. Engineers, quite a bit, pilots, things like that. So I deal with these folks a lot. And the pain point they have is they make great money and they spend great money. The positive for them is most of them already own a home by that point, and they have an immense amount of equity. So what we do a lot is I'll either do an 80-10. So we've got, first and the second year, we're going to pay off all this other debt. Now you may go from a 3.25% interest rate, 2.25% interest rate to a 7.5% interest rate. You may go from a $400,000 mortgage to an $800,000 mortgage. However, I am going to take all of that $400,000 at 30% on your credit cards that you have and all this other nonsense, and I'm going to consolidate it into one payment and one amortization at 7.5%. And when you look at that number across, with them making the exact same payment they pay things down exponentially faster. So on a refinance, that's something that you can handle with them. On a purchase, maybe they want to sell that property, pay off all their debt, and buy another home, and use that equity to do so. And they upgrade, and their outflow goes down as well. It's another thing we can do for them. Whereas everyone else is kind of telling them no, because their financial planner wants all of that money invested.
Right.
And I'm telling them I can save you $19,000 a month, and you get a nicer house, and you keep the exact same stuff. It works out great for them. So that's a problem that I solve for them. But what you could do is you could say, do you make great money, but also spend great money? What if I told you I could save you up to $25,000 a month, like I did with Jared, and then I've got a testimonial from him. He saved me $20,000. Took me 3 weeks. It's amazing. You should do it. Don't just take my word for it. Here's Samuel, and then Samuel speaks. Again, perceived likelihood of achievement. And you tell those people when they're doing, you don't tell them what to say in it, but you go, hey, would you mind doing a testimonial? Like, I just saved you $19,000 a month. Would you mind doing a testimonial for me? Awesome. Could you mention that we started on this date and we closed on this date? Just mention that it was this amount of time. Yeah, absolutely. Well, there went my time delay, right? Effort and sacrifice. It was so easy. All I had to do was this. I'm like, will you just tell them about the process? And then I send that to people. I will send that to people that I know are in their circle. I'll send that to financial advisors. I'll send that to high-end boat luxury insurance agents. I'll send that to marinas. I'll send that out to the country clubs. Hey, if you want to save, and maybe it's not $19,000. That was the most I ever saved somebody, but maybe I'm saving them $5,000, right? I'm saving you $5,000. You get a nicer house and all your stuff's paid off. Like, it's way better. I saved one guy, I believe $300 and some odd $1,000. And when you compare amortization to amortization, and it took him like 10 days to close. I mean, it's wild stuff. So that type of an offer, you want it to be so good they feel dumb saying no to it. And then you go and put it where they're looking. You'll never see a Lamborghini TV commercial. They don't put them on there because their audience isn't on TV. So if you want to know where to market, where is your avatar looking? And then go all in on that.
And that's my curiosity is, are you looking for that avatar by casting a net, whether through social or other means, or are you specifically targeting individuals that meet this McMillionaire profile and go and direct to them?
So I'm putting out the offer where I know those people are looking, and then those are the people that call me. As an example, if I were to put out a flyer for a down payment assistance loan in a country club, I would never get a phone call. It would never happen. Not going to get it. If I were to put my offer in a country club, people will call me, but not the people that are not interested in the offer. So you take the offer, and the offer should have disqualifiers in it. You do not want to be the person that works with everybody. You want to be the person that works specifically with one person. The more targeted your advertisement is, the fewer leads you will get, but the more closings you will have from those leads, as long as your follow-up and stuff is good. So if you put the advertisement there, and you say, these are the problems I solve, and you put it where that avatar is looking, only that avatar will reach out. So it's not necessarily that you're casting this broad net, you're just putting the solution in front of them. And you want to put it in multiple places, because it takes anywhere from 6 to 8 times of seeing an advertisement for someone to take action on average. So you want to put it at their country club. You want to put it at the school that their kid goes to. You want to put it and sponsor maybe the local high school, but not just the local high school where your avatar sends their children, so they see you everywhere. Because when they do have that need, they're going to call you then, because you're top of mind. They only call the first person that comes to their head.
It seems like you could also do that by looking at homes of a certain value and certain equity amount, coupled with maybe a grouping of occupations, as an example, that would be indicative not of the C-suite, but people that are in that kind of director, manager level, or like you said, pilots, things like that, as a way to identify people with a high likelihood of being that McMillionaire that you're looking for.
Yeah, absolutely. And you can also do it at car dealerships. You go to car dealerships all the time. Like, I got a guy. Put your card there on the other deal. And I'm just saying that because that's kind of the person that I help the most. But if you go into, let's say that your avatar is the down payment assistance, that's fine too. Put all your offer and your avatars, put your offer where that avatar is. It could be anybody. Right. You don't have to go after this avatar. If you don't want to work with them, work with somebody else. I like that avatar because I can help them a lot. I make a big impact in them. And a lot of times, because they're engineers and data, software engineers, a lot of times, those people are very good with technology, so they can use the tech that I've built, and it's an easier process. If I was going after someone that might be 85 years old that doesn't want to use technology, I would not be a good fit for them because my service level will drop exponentially. My offer is just not good for that person. So I go after the people that are good at my offer. I'm not saying I will not help that person if they call me, but I may not be the best choice. There may be someone in my office that's better for that avatar, and I will send them to them. I send great deals that close all the time to other loan officers because I'm not the best loan officer for them, and I know exactly what it's going to take for me to go get another deal. I would much rather they have a much better experience with someone who's better at that thing than to deal with me and it not be a 10 out of 10 for them.
Yeah, absolutely. It's funny, I think that you mentioned this at the top, but so many LOs that I work with are just scared of narrowing their focus for fear of not having enough opportunity, right? You're winnowing down the opportunity pool, but I think it actually works in reverse, right? You're going to get more of the better folks that you can work with, that your specialty aligns with. And I don't know how you feel about this, but my feeling is nobody's saying you're locked into one niche. I mean, if you can, dominate one and then move to another or manage two, that's fine too.
Yeah, I look at it as if you have truly tapped out your marketplace for that avatar, move to a second one. What I would suggest is instead of moving to another avatar, because I think a lot of times what loan officers do is they'll say this doesn't work, and it's really just they haven't put in enough effort. I think they grossly underestimate the amount of effort that it takes to truly do something great. Instead of switching avatars entirely, add another one of the core four. So if you have done only cold outreach to your McMillionaire avatar, right, and you've done only cold outreach, and you've blasted that person with cold outreach, and you literally cannot put more inputs in, you cannot optimize the funnel any further, start adding warm outreach as well, and you will see growth there. Once you've done all of that with warm outreach, now go into affiliate. Max that out with that avatar because they compound. And then you go into referral. Once you've gotten all four of those and you cannot actually make them any better by the data, you cannot get them any better, now you can add in a second avatar. I don't think it's bad to have more than one. I just think that people switch way too soon instead of optimizing. They do what they know to the best of the ability, and then they switch to another avatar and they dilute both because now their offer is over here and they've got this offer over here, and now no one really knows why they work with them. Right. So I think you just go all in on one and then add another one of the outreach methods. I think you'll do substantially better.
I'm so glad you brought that up. I'm a big proponent of kind of what I would consider like growth stacking or channel stacking, right? Like dominate one, master that thing, whatever that outreach mechanism is, and then layer on another. Don't try to go after 5 or more, simultaneously, because you're just not going to do it well. So like to your point, like be an expert, right? Really master with that thing and then start layering on additional items. As a marketer these days, I mean, it's just mind-boggling how many opportunities there are. There's shiny objects all over the place, and I think people get lured into that too much, right? You get yourself spread across all these different channels and different outreach types, and you're just kind of mediocre at everything.
Yep. They're working incredibly hard, but all they're doing is entertaining themselves. They're not actually making progress because everything's shiny, shiny, shiny.
Right.
Get rid of the shiny, go back to the hard stuff, but they grasp at the shiny because it looks way better than the hard stuff is. Unfortunately, the hard stuff is what works.
Yeah, no, I totally agree. I mean, it's funny. We see thousands and thousands of people marketing and see what works and doesn't work, and so we're in an interesting position there. But we're seeing direct mail perform really well in the mortgage space. It's just, it's kind of the bread and butter, right? It's the blocking and tackling of marketing. And some people are like, oh, it's kind of old school, but it continues to produce. I'm curious if you're using direct mail a lot, how you use it in conjunction with other things. What's your feeling there?
When I started in this business, that was all we did. I mean, we were doing hundreds of thousands of direct mail pieces a month for refis. I think direct mail works incredibly well, but there are caveats to it, like with anything else. So direct mail works really, really well for refis. I've never seen anyone do it at a very high level for purchase business.
Right.
So again, if you have a defined avatar and you have a defined offer for the avatar and you send them the mail, it's no different than sending them an email or something else. You just have to know the open rates and things like that. So you can optimize for it. Windowed envelopes worked incredibly well for us with, first notice, second notice, third notice, final notice. Make the final notice pink. Pisses a lot of people off, because they go, my mailman thinks I'm behind on my mortgage. It's like, but you opened it. So the first thing you have to do with direct mail, you have to get them to open the letter. Once they've opened the letter, you have to get them to the value immediately on the letter. I've seen some of these and they're like this big. Don't do that. Do you want to save this much money per month? You have this problem, call this number and I will solve it. And they are not going to call you on the first one. And then they're going to get a second letter about a week later, and it's going to say, you didn't call me, you still have this problem. And then they're going to call you on the third one. Maybe it's the second round that you hit them 90 days later with, but it does work. On average, when we were doing it, it was anywhere from 49 to 53 cents per mailer that would go out, and we expected a 0.8 to 1.4% call rate. So for every 100 letters, and we had a really good letter with good call to action.
That's good.
For every 100 letters we'd get about one phone call. From the phone calls, it would take about 9 phone calls to get somebody into underwriting. And we had a 73% pull-through rate on underwriting. So what you have to do is you have to look at, okay, well, how much money is it going to cost me to close this many loans? And how much am I going to make on the loans? And does that offset this? And am I willing to take the risk? But direct mail works incredibly well. I don't think you should do only direct mail. And this is the downfall that I've seen so many companies have. Direct mail works great until it does not work. And you will not know if it worked until that final notice one went out. So now you've spent $100,000 on notice 1, $100,000 on notice 2, $100,000 on notice 3, and $100,000 on notice 4. You spent $400,000 to figure out that campaign only made you $35,000. And that's where I see people get screwed. It works really, really well till it doesn't. So you need to have more than one outreach method. You also need to have upsells and downsells for these. How can you offset the cost of them saying no? Well, if you don't want the mortgage and you can't do it right now, do you have some sort of a channel to put them into to offset the marketing cost that you spent on them?
Yeah, no, I think there's a lot of good stuff in what you just said there. I mean, all of that is predicated on measurements and understanding what's working, what's not. So I mean, as you approach direct mail or any other campaign, how are you establishing the measurement and determining what's appropriate, what you need, maybe like to your point of 0.8 to 1.8. I mean, how do you determine that's the range that you need, and then how do you measure that you're actually getting that or not getting that?
Yeah, so I do this with anything that I do. I back into it. And I build everything into a funnel, right? So whether I'm doing cold outreach for calls or DMs or text or whatever, I take the copy, I take the channel, and I take the number of times that I did it, and then I check how many times I have to do it to get a lead. Of the leads I got, how many of those turn into pre-approvals? Or apply. How many of the ones that apply turn into pre-approvals? Of the pre-approvals, how many go under contract? Of the contracts, how many go into underwriting? Of the underwriting, how many close? Of the ones that close, how many refer a deal within 12 months? Because if you've got something that you can do 57 times and get an application, or you've got something you do 107 times and do an application, it seems like the one that you can do 57 times is way better for the applications. But if your pre-approval rate is half of what it is, they're about the same, right? And if your contract rate then goes down, you can get a lot of leads, and this is where I see so many loan officers fall into a pit. They get a ton of busy work, they get a ton of leads, group texts, emails, work with this person's got a 422 credit score, they've been denied 9 times, but you got 150 of them. It doesn't work that well, right? I'd rather have one client that closes than 150 that maybe are in the pipeline for 2 years from now that aren't going to close. So you want to track everything. The 0.8 to 1.4 that we were getting, that was just the number that we got. You want to look at what is the market average, and are you at or above the market average? If you are, fantastic, great. Can you make it better by a giant amount? Maybe. We never figured out how to do so. Look at who's the best at it and try and figure out what that number is. A lot of times they'll just tell you, I'm at this. At the time, Rocket was right there at the same number that we were at. So we were like, well, with the mail, we're not going to get it much higher. But you want to look at it. Let's say that it's going to cost you want to find two numbers. The cost per lead, the CPL, and then the cost per funding, your CPF. Once you know your cost per funding, how much money do you actually make on the deal on average, right? So if your cost per funding is $900 and your actual revenue, your net revenue on the loan is, $2,000, I probably wouldn't scale that. You want to have a 3-to-1 ratio. Your CAC, your cost to acquire that customer, your cost per funding, should be 3 times what your your revenue on the client should be 3 times your CAC. The lifetime value of that client has to be 3x what it costs to get them. Once you have that, you can scale. Until those numbers align, do not scale it because you will fail.
Great rule of thumb. And I feel like in there, from the point at which you've got a lead to funded, there's a couple things at play there, right? There's the I've generated a lead. Now, how effective am I at converting that lead or moving that lead through my sales funnel, which could be a sales function. It could, to your point, also be a crappy lead function, right? So, which comes back to my ability to target. Am I going specifically after individuals that I know or have a high propensity to be approved, or am I casting a broad net and not sure what I'm going to get in, which could generate a crappy lead? So, those are great things to look at. I like distilling it down to CPL and CPF. I think that's a great way to do it. And then just understanding that within that, there's a couple levers at play.
Yep. And once you know what lever to pull, it becomes so easy. It's like, oh, this is down. All right, we'll do this now. Or this is down. Cool. And a lot of people say, oh, I'm working on getting better. I want to get better. I want to do this. I want to do that. And they go to these events and they take pictures of the slides and they come back and they do absolutely nothing. If you don't change what you're doing, you will continue to get the same or worse results because the market moves and what you're doing does not. So it's not that you're going to get the same result. You're going to get progressively worse results. You have to change those things. But you also have to track everything so you know what to change.
Yeah.
That's where they're so afraid to change anything because they don't know what it is that's actually getting them the loans.
Like that. I've heard you talk about the importance of kind of narrowing in your niche also based upon like age, right? The individual's age. And I think you have like a 7-year band that you recommended. How did you settle on that? Why do you think that that's an important component? And what would you recommend people do with that as they're developing their own niches?
Yeah, I believe it was a Harvard study. It might have been Yale, but I think it was Harvard did a study that your personality is almost entirely different every 7 years. And they were doing a study on marriage rates, and they found this, that like every 7 years, it seems that the people are reporting, oh, he's just changed, or she's changed, a different person now, their interests, their wants, their goals, their needs, everything's different every 7 years. So if you're going in and you're saying, well, I deal with first-time home buyers between the age of 25 and 40, you ever talk to a 25-year-old and a 40-year-old? They're very, very different most of the time.
Different life stage for sure. Yeah.
Completely different wants, needs, goals, interests, technical ability. They're just very different people. So if you're trying to hone in on an offer, why on earth would you group those two together? I mean, and it's really, 7 years does seem to be the thing. If you talk to a 25-year-old and a 32-year-old, they're very, very different. If you talk to a 35-year-old and a 42-year-old, they're very different people, So if you're mixing these in, you want to hone that age group in. And I'm not saying to discriminate by age, but know who you're marketing to. You could have a different offer, and it could be the same end goal. But if you're trying to offer, you're building everything around an 18-year-old that's never bought a home before, or a 45-year-old that's never bought a home before, they're two very, very different people, and you need to change your copy, where you market it, all of that has to change because the 18-year-old's probably on TikTok. They're probably, somewhere that hanging out with their friends that the 45-year-old should not be. He's probably not watching the same algorithm on TikTok that the 18-year-old is, right? So you want to make sure that you're putting everything where that person is, and their interests change, so their eyes change. Where they're looking changes, and what they actually want out of it changes. If I go to a 21-year-old today and I try and offer them a digital mortgage, they are much more likely to accept that than a 95-year-old. The age matters, and it's every 7 years it seems to go up a tick on how much it matters. Not necessarily they should not get the dream outcome, they absolutely should. It's just how you need to provide it to them is going to be different.
Yeah, I mean the dream itself changes, right? Just because you have different things going on. You now have children, and you've got college around the corner, all these different things happening. So, yeah. So let's talk about that. I mean, so let's get tactical. How would you go about now blending? You've got your products that you offer, right? You've got your specialty, your niche in terms of the dream outcome or the pains that they have, and you now have the kind of age buckets. How do you go about pulling these together to create an awesome offer as well as a really cohesive message that's going to land with that specific group?
Yeah, so the discovery is what it all comes down to. Two things, the discovery and then that value equation. So you need to do the discovery. Now you know who the avatar is. You go out, you do the discovery. You have a conversation with 500 of them on that goal, on the dream outcome, on what's going to keep them from getting there, because that'll get their wheels turning on it. People are not asking that question. Well, how are you going to get there is usually what it is. It's what's going to keep you from it. And then you solve for that. Then when you understand at a deep level what their dream outcomes are, you figure out a way to solve them, and that is the value equation. Perceived likelihood of achievement, effort and sacrifice, all the stuff that we talked about earlier, time delay, and you build that offer. Then you pick one of the core four. You pick cold outreach, warm outreach, affiliate, or referral. You do any of them you want to do. And then what you do is you go all in on one of those, and you track everything. So how many times do you have to take this action to get a response in cold outreach? Of the responses, how many of them actually turn into a lead? Because they're two very different things. Once you have a lead, how many of those apply? Of the ones that apply, how many get pre-approved? Of the ones that get pre-approved, how many go under contract? And you just, all the way down, that's the funnel. And now you know exactly what to look at. Because most of the time, people tell me, if I had more leads, then I would close more business.
Right.
You would.
Right.
Your whole process would break. Everything would break. If I dumped 100,000 leads on you, you would break. People like to say, Rocket spends $1 billion a year on advertising. That's why they're beating me. No, it's not. They have an offer that they're putting out. They're putting it out there. But if you had that same $1 billion in advertising, your entire company would crumble. You don't have the infrastructure. You don't have the process to handle those things. So you look at where you want to go, not where you are, and you build your process for that. So once you have this and you have this funnel, it's like, okay, well, what can I do? I want to get to 1,000 loans a year, right? What can I do at 1,000 loans a year that will work today? Because if you build your process around fixing this funnel on something that won't scale out to where you're trying to go, you're going to hit a bottleneck and you have to deconstruct your tower and build it again. So you've got the avatar, you understand what they want, you have the offer, you've picked one of your core four, you're tracking everything. Now it's time for process, and you want to make sure that the way that you're converting this funnel from top to bottom will actually work once you get to where you're trying to go. And now it's just a matter of doing the work.
I like that. I like those. As you were just talking through that, one thing just hit me hard, which was just why is Rocket kicking my ass, right? I think part of that is because you're playing their game, right? Which these independent mortgage brokers have a unique opportunity to do things, in my opinion, that don't scale. So the things that you can do in your local market to establish yourself as a specialist, kind of to your point around, I go after McMillionaires and I focus on this age bracket and in this channel. Rocket can't do that. Rocket cannot do that at scale. What you can in your local market, and you can dominate, and you can really differentiate, I believe, and that's how you win. So
the biggest thing with
love that.
They are going to beat you at scale, but they can't beat you in your neighborhood. They can't go knock on Miss Johnson's door down the road and say, "I baked you cookies." Do you know anyone that meets this, that has this problem? They can't do it. They're trying to get boots on the ground now. I'm starting to see they've got some local teams that they're starting to put into the market, and that's great. But at today, they're not going to be able to ingrain themselves in the market the way that you can locally. And that's where it's a local independent mortgage broker or local loan officer if you're retail. You're local. Beat them in your circle. Don't try and beat them. Be the best and beat them here. Don't try and beat them at scale, because you don't need $30 billion a year in origination volume. You probably need 30 to 60 million. You can definitely get that in your market, and they won't take it from you because it's a drop in the bucket to them. But it's all you really need. Beat them local. You don't try and compete with them at scale. Yeah,
I totally agree with that. Why do you think LOs tend to overcomplicate this, make this such a difficult thing? I mean, because I think what I'm hearing you say is just understand your space, get very focused and very niche. Yet this is a really challenging thing for LOs. It's not natural. How do you help them just simplify and make this actionable? I think, as you mentioned, like going out and speaking to 500 people probably scares the shit out of people that listen to that. But I understand the reason for it, and I think that's very valid. But how do we make this actionable and simple? What's the bite-size or stepwise approach to getting there?
Yeah, so you're not going to do all this in one day, right? If you're looking for a magic bullet, I don't have it. But again, like Hormozi says, I got a bunch of golden VPs that are going to help you here. First of all, if you're going to succeed in this business, you're going to have to start accepting certain things. Number one is you have to start saying no. If you don't say no, you will never make it in this business. It won't happen. I've seen people that have been in this business for 20 years. Now, I've been doing this 20 years, and I closed more loans last year than they have their entire career. You may be here, but you're also going to be driving an Uber on the side. You have to start accepting certain things, and one of them is you have to say no. You cannot say yes to everything. You cannot be yes to everything. Once you start saying no, it's terrifying. This is where I lose a lot of loan officers. They're like, I'm not going to say no. They'll stop sending me business. Good. Or I said yes to this agent with a $40,000 deal that's at the last minute, that's already burned through 4 other lenders, that doesn't have bank statements, that has a gift from mom that's cash in Barbados. Like, do not say yes. Do not pick up that mess because it was already destroyed before you got it. Well, I want to get their other business. Hey man, they're doing a $40,000 deal with the gift funds from Barbados that's died at 3 other lenders. Maybe you don't want the rest of their deals. Maybe you need to help them figure out their why and their avatar so that they can get better deals as well. That's the value you add, not saving that thing. You have to learn to say no, because if you don't say no, you will lose. You have to define the avatar. If you do not have a defined avatar and you think that you are marketing, you are just entertaining yourself. You are not marketing. If you are marketing to everyone, you are marketing to no one. You've got to understand who you are marketing to, or you're not marketing. Once you understand that, you have to define the offer, and you have to understand that it doesn't matter how good you think the offer is. It is how good they think that the offer is. If they tell you the offer's bad, go back to the offer equation, ask them which of these would you say it is, how would you improve it, and now your offer gets better. A no is not a no. A no is only feedback to make the offer better. You should get no's. Calculate how much money a no makes you. If it takes you 341 no's to get a yes that closes, divide your average commission by 341, and that is how much money each no pays you. So when someone tells you no, it's not a dead deal, it's $23.86, right? So now you go in, you're like, yes, $23, and you go to the next no, and you're trying to get no's now, because every one of them is $23, and then you get the yes. And that's not going to be that the 331 first call is a yes, but at scale, what is the no cost?
That's right.
And over time, what is it? Once you have that avatar, once you have the offer for them, track everything. That is where everything dies, is if you do not track it. If you can't track it, you can't quantify it. If you can't quantify it, you cannot get better at it. If you can't get better at it, again, you're just entertaining yourself because there's no consistency. You have to track it. You have to be consistent. You can't go out and call 10 people and then not call anyone for 4 days, and then call 10 people and then not call anyone, because they're forgetting about you. If your method is cold outreach and it's social media, let's say, post 4 times a day. If you're listening to this, you've probably been on social media today. Can you tell me 5 people that posted? I can't. I've been on TikTok and I've been on Facebook. I cannot tell you who posted. I don't know. They forgot already. So keep posting so they don't forget you. You're not going to annoy them. It doesn't show it to everybody that follows you anyway. It's going to show it 300 people, post again. You're probably going to get 200 different people, and 100 of those people that already saw it, and they're going to remember you. Consistency. But to be consistent, you have to track it. So have some sort of metric to track these things. If you want to go a lot more in depth with this, 99% of what I do is completely stolen from Alex Hormozi. Go to acquisition.com. He's got free courses on offers, on leads, he's got one coming out on money models in like 2 months. It's going to be incredible. He's got a full scaling course from 0 to 100 million telling you exactly what to do. It's all for business, but guess what? You run a business. You are a business. Act like one. If you're going to go in here and, lackadaisically call maybe a couple people, or even worse, this is the worst thing a loan officer can do. They do the work up front for about 6 months. They work hard. They get 3 people referring them 1 to 2 loans a month consistently, and they never do outreach again. They never do outreach again, ever. And they pander to those 3 people, and they work for those 3 people night and day, weekends, 11 o'clock at night, because they're terrified, because if one of them leads, they have to go do that hard work again. Do not be that loan officer. You already got the 3. Go get 3 more. Continuously get them and track it all, because the market's going to move. Those agents are going to retire. Someone's going to take them from you eventually. You have got to continue to do it, because if you've not done outreach consistently for 8 years and you've just been comfortable with what you built a decade ago, once that's gone, switching that switch back on to now do it again is incredibly difficult.
Real hard. Yep.
And you're going to get out of the business. You've got to keep it going. You've got to keep it going. So define the avatar, define what they want, put it into the value equation, pick one of the core 4, do so much of it that it would be unreasonable for you not to succeed, and track everything, and then optimize what the weakest point in the funnel is every time.
Russell, gold. Appreciate it. And thank you for sharing the sauce. This was very actionable and insightful, and I think people are going to get a lot from this. If you got something from this, please hit the subscribe button. Make sure you share this with a friend or colleague that can also get some value. And we'll have to schedule more time together also to go further. This was fantastic. How can people learn more about you or connect with you?
Yeah, so on Instagram, I'm Mortgages by Russ, or you can just add me on Facebook, just Russell Petty. I'm on there, and I share actionable stuff, a lot about AI. That's what I do from day to day now is AI and technology and all of that. So, if you want to learn about that and how to use that in your business actionably and not the fluff, give me a follow, and I'll teach you how to do that too.
Fantastic, man. Thanks for being on Local Leverage. It's been a pleasure.
Thank you. Appreciate it.